What is a tax-deferred retirement plan? You're probably wondering, what is it? How does it work? Do I have one? Do I even know? That's what we're gonna talk about in this video right now. So you're probably wondering, what is a tax-deferred retirement plan? Like, what are they? How do I use them? Are there advantages to them? Are there disadvantages? Could I be doing something better? By the way, you could be, depending on your situation. And that's why I wanna make sure you stay for this video, because we're gonna talk about that right now. All right, so what are tax-deferred retirement plans? Well, obviously, one, they're not just retirement plans, but they're tax-deferred, meaning you usually put them in with pre-tax dollars. That means that money's coming out, and either one is coming out of your paycheck, like going into a 401k plan, right, where that goes into your company, comes out of your paycheck, you don't pay tax on that money, it grows tax-deferred, but then it comes out and you get taxed on it. Or two, maybe you're investing with your own money, you get a little tax write-off now, but then after it grows and accumulates tax-free, then you later on when you cash it out, it's really getting taxed, right? And that's why they say it's tax deferred. It's deferring your taxes down the line to whenever you actually take it out. Now understand, these are often called qualified retirement plans. You'll hear that as well. But tax deferred, and these could be annuities, 401ks, IRAs. Technically Roth IRAs are more in the tax-free, but they can be in the tax deferred category somewhat. But anything that's, again, not being taxed today to be taxed down the road. So really, instead of paying tax on your seed, you're being taxed on the fruit down the road. Now, because they're qualified plans, they often require you to wait till a certain age. Now, you might work for the government or maybe as a teacher, you might be able to get access at age 55, but for most of us, if we're not government workers or working for a teacher union or something like that, we're probably gonna end up paying, not getting access to this money, at least not without penalties, until we're 59 and a half years old, based on the current age. I know there's always talk about, will they change the age or not by the time I get there? The answer is, we don't know. It depends on the government. If you trust the government, it might not change. If you're like me, you're like, well, can I trust the government with anything? I don't know, it could change. What if they decide to bump it up to 62? Well, that's when you can actually access it without those early withdrawal penalties. So understand that tax deferred, although it's good because you can at least grow your money and tax, where it's not being taxed at all, you can let it keep growing, but just know that when you do access it, you get taxed at that time. When is this better? This is better if, again, you trust the government. I'm sorry, I'm not trying to laugh at you guys, but let's be honest. I mean, how many of us trust the government? I know there's a few of you that do. So congratulations, I'm glad you do. But Gen Xers generally don't trust the government because we've seen it over the years. But when you talk about the government, right? If you trust them, or if you trust your situation to be at a point where you're gonna have less money, you're gonna take less income in the future, then yes, you could be in a better spot because you might want to take the tax deduction today when you're in a higher tax bracket than later. By the way, that's actually how the 401k started back in the 1970s. The 401k was only designed to be an executive bonus. It was an executive type of plan that they were able to use because back in the 1970s, did you know that the highest tax bracket was almost 90%? That's right, 90, not 19, 90. It was up in the upper 80s. It was like almost 90% was the upper tax bracket. So of course, what did they want to do? They said, I want to defer those taxes. What if I can keep my income lower so I'm in a lower tax bracket, set it off to the future, so then I wouldn't have to pay as many taxes? Which, by the way, they actually gambled correctly because once it got past Reagan's era, taxes came down, they were actually able to have a benefit. Here's the problem. For the average man, the average working man or woman, right? Those benefits, that 401k became available about 1985. Well, now at this point, taxes are already starting to come down. So people are trying to defer their taxes, but now currently in this current environment, we're at one of the lowest tax rates that we've been in the last 110 years that we've had the federal income tax. So when you're trying to defer that tax to a future date, the question you have to ask yourself is, will taxes go up in the future or down? And that's a tough one, isn't it? Because we all know that there's a high likelihood they could go up. Now, it could go down, or maybe you're just gonna be in a place you live so cheap they don't have to do it. I'll tell you this, most people that become our clients that hire us, they don't want to minimize their money in retirement. They want to maximize it. They want to actually have a lifestyle. They want to have a life that they can finally live of freedom. A life where they say, I don't have to use money as an excuse that I can't go visit my grandkids whenever I want. Even if they move to another part of the country or even across the world, I can still go see them. That's where a lot of people want to have more freedom. That might require them to spend more money, putting them in a higher income tax bracket. So as a result, do we want to defer taxes till later? It just depends. I do kind of joke sometimes because it's kind of a sad, not funny, but funny truth, is that if you often use traditional financial planners, people that get paid not to make you money, to make themselves money, right? If you actually use those guys, you might end up living on lower income down the road. That's a sad truth, but it's been a real truth, is that so many more people are living on less as they get into retirement, not more. They're not having more freedom, they have less freedom when they stop working. This is why there's even money managers out there today saying, no, don't try to retire at 65, wait until you're 70 or 75 and then retire. They're doing that because they see far too many people, the vast majority of Americans, about 98% or more, get to a point of retirement and say, I don't really have a lot. I don't have a lot to live on. If it weren't for Social Security, they wouldn't be in a good place at all. So some of them, I would say there are about 10% of Americans that are doing okay, like especially because they have Social Security and other things coming in. But there's the other 90% that are not okay because they follow traditional financial advice. And then even worse, even when they need the money the most, what happens? You got to pay taxes on it. Give you an example, I had a client that had $1 million he happened to save up over his whole career, turned 60, decides to retire from the military. He then goes to his financial planner, and the financial planner says, great, you can now live on 3% a year. That's $30,000 a year. I will tell you, at that income bracket, yeah, he's gonna be a lower tax income bracket. But the thing is, hey, I live in California. Homeless people live on $30,000 a year. I don't wanna live on that. Things are way too expensive to live on $30,000 a year out here. I want a better lifestyle, which is why we started putting that money more into real estate where there's some tax advantages. And so he didn't have to pay taxes on everything. He was able to get a lot of that money. And actually his income, rather than taking $30,000 a year, was over $100,000 a year. And he was able to pay less in tax than he would have pulling out $100,000 from just his normal IRAs that he had. So that's what a tax-deferred type of plan is. It's like your 401ks, your IRAs, where again, they defer your tax to a later date. I like to call it more income deferred, not tax deferred, income deferred, because really all you're doing is you're taking your income and just deferring it to a later date in hopes that you might be paying less in tax. This is why there's such an argument for Roth IRAs. Many people like Roth IRAs because yes, you pay taxes on the seed, you use after-tax dollars, like when you get your paycheck, you can then invest in a Roth IRA, but then it grows tax-free and then it can come out tax-free. I even know a lot of people, they do alternative investments because we talk a lot about alternative investments, like not just real estate, but sometimes people will do active business stuff, or real estate type based transactions that can make a lot of money, even if they're doing like, notes and things like that, almost like what banks do when they do mortgages. And they can make millions and millions of dollars doing that. Some of them will love to do it inside of the Roth IRA to be able to have that tax-free income down the road. So there's a purpose for that too. Many of our clients also do things that are much like the Roth IRA, but they'll do like infinite banking. They'll do use life insurance, not as a way to just save up for retirement, although you can do that and make a decent income stream for that. But more importantly, instead of just having a tax-free income stream, what if you can use that money now to invest it in another place and you can actually make money in two places at once? Now we got some cool things happening, right? And so that's kind of where you get that, yeah, you could do tax deferred, but what about tax never, right? So that's where Roth IRAs come in. Just Roth IRAs can be a good option, but you'll realize that funding a Roth IRA, they usually only let you do $6,000 or $7,000 a year, depending on your age. Not a lot of money to get rich with, unless, of course, you can make a lot of money with it by doing some creative strategies. If you're not being creative, if you just have it in the market, you won't make much money. And that's why a lot of our clients use more infinite banking, where they can put in up to 25% of their gross income every year into those kind of plans and have some flexibility. And of course, they protect their family at the same time. And here's the other thing too you can do. Now, let's say you do have this tax deferred plan. Maybe you already have an IRA or 401k. People will say, well, Chris, should I keep funding into these things? Should I keep putting money in here? Or should I do more with Roth? Should I do more with this life insurance strategy you're talking about? And the answer is you could. I mean, everybody's situation is different. You can always reach out to us at moneyripples.com and contact us for questions like this. But here's one thing you consider too, is that one, I don't like people locking money up in prison, especially if you have a goal to retire before you're 60. The thing is, you don't want to do these tax-deferred plans. These tax-deferred plans, unless, like I said, you're a teacher, you might have till age 55, or a government worker maybe. But if you have like a 401k or IRA, you're gonna have to wait till you're 59 and a half before you can touch that money without the 10% penalty plus taxes on top of it. You could lose 40% or 50% of your money depending on which state you're in and how you're being taxed. So the alternative is, instead of locking my money up in prison and those things, what if I kept my money here? What if I did fund that life insurance strategy, that infinite banking strategy? What if I did do that and instead use that money to invest in alternative investments like real estate backed investments that could pay potentially double-digit returns? Again, there's always risk, results may vary, yada, yada, right? Like we all know that, of course, you can always lose money in anything. But still, what if you put in those things instead, just like our client did when he moved his $1 million and to generate over $100,000 a year in income doing that versus $30,000 a year? That's an option. You can even do what's called a self-directed IRA, where you still keep it in IRA. It's still tax deferred, but then you invest it in other things besides stock markets. So if you're worried the stock market will go down, what if we move that money over and start investing in real estate backed deals? What if you could start earning and compounding money faster over there than you would in the stock market? Lots of alternatives you can actually do. So like I said, if you really want to know, like, what are the options? What can I do? One, subscribe to our other YouTube channel called the Money Ripples Podcast channel. Check that out because we got a lot of cool podcasts that we do that we teach, as well as our guests will teach as well. But then also moneyripples.com. You can actually see what kind of money you could create by using our passive income calculator to see what kind of passive income you could create in your life right now. So do that today.